Hello, everyone. There I am. Uh, Thanks for joining us today. Um, Looking forward to sharing some information about partnerships and buy-sell agreements. So, with that, let's get kicked off here today. Again, we're going to be talking about buy-sell agreements and how to protect your business as it relates to partners. And specifically, we're going to look at different events that may happen during the life of a partnership that trigger a change in the partnership that may necessitate a buy sell agreement. And yeah, so that's our topic for today. My name is Stan Doida. I'm one of the founders of Doida Crow Legal. Doida Crow Legal, we are a boutique corporate securities and M&A law firm. We specialize in helping entrepreneurs grow, finance, and buy and sell businesses. I think the things that make us unique are we're entrepreneurs as well. So we bring a level of practicality and pragmatism to how we practice law, how we solve problems, and how we plan and build companies. Um, we focus on the client experience. So, in the course of working with us, we want to coach you up, help you become a more savvy and sophisticated entrepreneur. We want to keep things moving. We want to be good representatives of your company. And then third is fixed fees. About 40% of the firm and 60% of what I do is on a fixed fee basis. So basically, that means if we can scope out the parameters of a project, we'll give you a fixed fee on it, and we'll cover it from start to finish, and regardless of how many iterations it may take or how many conference calls or explanations it may take, we're gonna cover all that and make sure it gets done right, exactly how you want it. All right, well, let's jump in. Um, you know, so we're going to talk broadly about partners. I think partners in the legal sense is limited to quote partnerships, but I think in the colloquial sense of it, it refers to your co-shareholders in a closely held company, members in an LLC, or partners in a partnership. Um, these different entities have different organizational or charter documents, as they may be called, that facilitate or house these agreements. In the corporation, it's unfortunately kind of housed in three or four different spots. Certificate of incorporation, bylaws, shareholder agreement, and then shareholders may have individual vesting agreements or conditions related to the shares that they own. In the LLC or a partnership, it's nicely consolidated, typically into a single operating or partnership agreement. So it's look in one spot rather than trying to piece together all the stuff that a corporation typically has. Oops. So what is a buy-sell agreement? A buy-sell agreement is agreement between the company and the other members or shareholders, partners, again, regarding the purchase and sale of equity interests in the company. Um, it could be shares, it could be units, it could be membership interest, whatever the the company uses as its denomination of ownership. That's what we're talking about. And why is this important? Um, During the course of a company's life, there are certain extraneous events that could happen, some within a partner's control and some outside of a partner's control, that can happen that would cause a substantial change in the partnership. I think the one that everybody thinks about is death, right? If a partner dies, the question becomes, well, does the dead partner's spouse become a partner? Often, when I'm meeting with founders of a company or entrepreneurs, that is not the intended result. It is not intended for the spouse of a partner to step in as a co-owner and co-operator of that business. But absent some planning, that's what might happen. So the other events are things that may happen by operational law. So maybe if you go bankrupt, or if somebody has used their shares or units as collateral for a loan and then defaulted, and the lender is going to take possession of the units. These are all things that can cause units to move from the original partner to a third party that we didn't intend to ever be a partner of ours. So buy sell agreements, super important. Honestly, it's one of the sections that I see most often omitted from an operating agreement or partnership agreement that comes from other sources. In our firm, we're almost certainly going to cover this in an LLC for sure, and in a partnership for sure. Corporation, sometimes depending on what the plan or the strategy for the corporation, it may be intentionally omitted, but we're going to address it in an intentional fashion, at least with the clients, to discuss whether or not it's the right fit to have one or not, and how it's structured. So, quick overview. That's a quick overview of a buy-sell agreement. We're going to talk about the structure, real high level, the things that you got to cover. What are the events that are going to trigger a buy-sell event? What happens in those events? What happens to the shares? What happens to, what's nice about an LLC or a partnership is in that event, we can usually sever the voting rights associated with those interests from the economic rights, from the right to receive distributions or liquidation proceeds. We can say, hey, you know what? You still have your economic interest in this, but your voting rights are gone. So that's one thing that's nice about LLCs, partnerships. Then it becomes a question of, okay, so now this event's happened. Are we going to buy these units out? Is the buyout right? Is it optional? Is it the company's option? Is it the other members' options? Or is it mandatory? Like, must the company buy out these units if this event happens? I think that can depend. Oftentimes we're representing the company, and I like to provide the company with options. And so often it's an optional buyout. The company can choose whether it's the right idea to buy out or not buy out when they see the circumstances. I've certainly been in situations where I've represented a member where we wanted mandatory buyouts, or there may be a certain type of company or certain type of industry where it makes sense that, hey, when this person leaves, we really need to buy them out. So we talked about that. Is it optional, mandatory? Whose option is it? Is it the company's? Is it the other members? Then of course, the big question is, how are we going to value these units? And I think the often forgotten question is, how are we going to pay for these units? So we're going to talk about all that stuff. We're going to talk about some hidden traps and some hidden problems with buy sells as we go here. Okay, first step is the triggers. Again, I think the one that everybody thinks about is death. Permanent disability or incapacity is often one. I think, especially true as a trigger for a partnership closely held where the partners are all owner operators, are all working in the business. A passive shareholder, you may decide that some of these triggers shouldn't apply. A passive shareholder whose services and energies aren't necessarily important for the business in order to carry it forward. If they die, that may not be of significant consequence to the business. So maybe that's not the right trigger for particular types of members or investors, shareholders, etc. But again, the triggers most common: death, disability, incapacity, some sort of bankruptcy or foreclosure. Again, in a situation where somebody's used these units as collateral for a loan and then they default. Judgment or judicial order. I think the one that's most often thought about is a divorce between a partner and his or her spouse. That maybe they're required pursuant to their settlement agreement or their divorce decree to transfer some of the business interests. Again, that may not be what the company and the other partners had intended or desired. So other triggers to consider are terminations of employment. If somebody decides, hey, this isn't for me anymore, I'm quitting, I'm going to go do this other venture or go get a job or whatever. But those might be other opportunities or other events that you say we really need to reconsider the partnership under those events. And again, that termination of employment that can be finessed to have um, either narrower or broader triggers. Any termination of employment, is it termination with cause, without cause, that sort of stuff. That can all be kind of addressed. Sorry, I keep hitting the back button. All right, so we talked a little bit about triggers that are going to trigger this instance of a buy sell agreement. Again, going back to the procedure now. Procedure, whose option is it? Is it the company's? Is it the other shareholders? Is it both? Um, I think there's tax considerations to consider in that, but often, again, when we're representing the company, my sort of default position is that the company has the first right of refusal to buy these units back. We might give the other members a right to buy them out as a secondary option. I've been involved in companies and cases where they say maybe these distinct members get the second right or the first right, and then it goes to a broader group after that. So all of that can be customized. They all have kind of different results. When the company buys back units, those units kind of go away. And if we're buying back 100,000 units, and before we buy back there were 1 million outstanding, we're buying back 10%. After it, there's only 900,000 outstanding. Everybody sort of reverse dilutes. They all kind of get a proportional increase in their shareholdings. When members buy it, assuming it's proportional, everybody gets that same proportion. They'll buy their proportional share of those 100,000 shares. When they pay for it, they're going to also increase their tax basis in all those shares. So there's a kind of, you're paying for it though. The individual's paying for it. So there may be some tax considerations to consider there. Um, and likewise, you may find that shareholders, I think probably more often than not, you'll find that if it goes to that way, that shareholders aren't actually buying it in proportion to what they were. So you might find a reshuffling of what everybody's percentage ownership is. Of course, as part of the buyout procedure, you need to consider notice and timing. I think, I think I was just looking at one this morning where the buyout is, must be exercised within 60 days. To me, that's a little bit short in some instances. I think, in particular, when a partner dies, especially if it's a significant partner or something like that. I think partners getting their ducks in a row to do an exercise of this nature can be tough to do it in that quick of a period, and it frankly is probably the last thing that's on their mind at that point. So I generally suggest that these decisions, again, representing the company, I want to provide the company with lots of options. I generally suggest that these time periods extend a little bit of period, a time period. 30 days, again, in the instance of death, you can imagine your partner dying, and then you're serving up his or her spouse with a notice within 30 days that you're buying out. That could be both insensitive and overwhelming to your, presumably your, trusted, deceased partner there. So all that stuff should be considered. I think oftentimes they're just kind of thrown away and just like 30 days. Yeah, 30 days is fine. But I think in practice, you'll find that 30 days in some of those events like death are just kind of inappropriate. And then what happens if you miss it? If you miss it, is this right gone? So I think you got to consider these procedures a little bit more than just, hey, throw in the boilerplate, throw in the standard terms here. Okay, the big question that everybody asks and that everybody wants to know when this comes up or when we're planning is, how do we value these units? I would generally say that there is three buckets. I see that we have four on here, but I'm going to kind of bucket two and three together. Um, I'll go through each of them. I'll tell you what I think works in most cases, but not every case. Um, so first one is book value. Book value is an accounting term, um, and it would really be derived from the balance sheet of the company at the time of this event. And you'd look at the company's equity, and you'd say, all right, well, the partner A who's dissociating or who's leaving the firm or whatever, leaving the company, is they've got 10%. So we'll give them 10% of the equity on the balance sheet. The pros to book value approach is that it's a pretty easy number to get. So you're gonna have an answer quickly. You're gonna have an answer easily. The cons are that accounting number is only looking backwards at transactions that have transpired up to that point. It does not account for it doesn't account for, say, trends that are happening in the business. That big customer, that big source of revenue that's coming in. It doesn't account for any of that sort of stuff. It doesn't account for maybe market multiples that may exist in a third party sale. So again, easy to get. Cons are it's probably, I mean, in a situation where a company's growing, that's probably artificially low compared to what might be fair market value. So again, pros, easy to get. Cons are it's may not be reflective of true fair market value. I'm going to bucket two and three in here. I'm going to call it an equation. Some people would say stated value. I've seen operating agreements, shareholder agreements where the partners agree that, hey, every year at the end of the year, we're going to agree on a value. We're going to state that value, and that's going to be in the operating agreement until we do it again. And that's the value that we buy. Same thing. Equation might be, hey, we're going to value this company based on this equation, which maybe it's a multiple of cash flow or net profit or whatever. Pros, easy to get. We've got it right there. The cons are, I think, with respect to an equation, I think one party is going to be extremely dissatisfied. I don't know which party that's going to be, but I have often seen an equation not actually be reflective of true market values. So, for example, you may have a company that is profiting $200,000 a year, and then you say, well, let's attribute a 6.5 times multiple on that net income, because that's what the market would get in an M&A transaction. Well, that's probably not right. That multiple may not apply to cash flow at that level. At a $200,000 level, that may only be a 2 to 4x 2 to 4x multiple, and it may really only hit 6 when you're at $1 million in EBITDA or something like that. So again, I find the equations to be again simple but wrong in terms of its accuracy to fair market value or market conditions. So, like I said, somebody's going to be unhappy. I just don't know which party it's going to be. Same thing with stated value. Stated value, again, that's the idea that maybe the board or the managers are going to, on an annual basis, establish a value by agreement. I think the fundamental flaws with that are when everything's going great, this is the thing that people never attend to because they're not worried about it. So I've seen situations where, one, that stated value, while it was supposed to be getting updated every year, had been years before the partners had ever reestablished a value, and then a dispute happens, and now we can't get an agreement on the stated value. So I don't love that setup for a company, because just having been an entrepreneur myself, I know that would be the last thing on my list of things to do each year. So the last one is an appraisal, and I'll tell you that we kind of use a modified appraisal. But an appraisal is at least going to get a third party expert's opinion on what fair market value is, or what fair value is. Those are terms of art in the valuation world. So again, that matters what you use in your operating agreement as to what the value is. Is it fair market value? Is it fair value? Is it discounted? You got to be talking about the right stuff there. But um, the pros to this are that I think it's going to get to a fair price. So whether you're the buyer or the seller in that situation, I think it's going to be quote unquote fair. The cons are that you probably got to pay some money and exert some time and energy to this in order to get the answer. So, whereas the other ones were super easy to get, this one is probably not as easy to get. It is my recommendation in the overwhelming majority of cases. And it is what clients often, are picking as their choice. I mentioned we do kind of a modified appraisal value. I like to give the parties a chance to agree first without getting an appraiser involved. And if they can't agree, then the appraisers start. And then you have to kind of think about, well, what happens if you got two really disagreeable parties? Are they going to really agree on an appraiser together? So then you have to start to think about, well, if they can't agree on an appraiser, what else aren't they going to agree on? So we start to build this, what I would call, a dispute, escalating dispute resolution. So you kind of take it to deeper tiers. But at the end of the day, if you go through this procedure, you will get an answer, you will get an appraisal value, and you will get quote unquote fair price. So that's often what is I suggest. I think a lot of the partners in my firm would suggest, and what clients end up choosing. Again, when you do this, you got partners. You have to think of yourself on both sides of the equation. You have to think of yourself as the remaining partner who may have to buy out the deceased or departing partner. There you want a low price, but if you're the partner deceased, there you want the high price. So again, I think when you put yourself in both sets of shoes, you start to think about overall fairness of the process. Okay, and I think one of the ones that often gets overlooked is, how is it going to get paid? So again, let's take the situation of a partner A and B are together, and partner A dies. It's not. I don't see a lot of companies just hoarding a bunch of cash in the savings account that is designed to do one of these buyouts. It's usually one of these events is usually coming at a relatively unexpected time. I mean, death being totally unexpected, but if somebody leaves or quits, or you fire somebody and that's triggering a buy sell, I mean, you probably haven't been saving up the cash needed for that over the period of time that it might take to pay that out. So how do you do it? Again, representing the company, I like to provide it with some options. So if the company wants and they think it's a good use of cash and they have the cash, they can always pay the cash. But generally speaking, I would set up as a backup plan a agreed upon financing terms, where maybe you're paying this out over 4 or 5 years, with some interest, and but it allows you to pull that partner out now. Say, hey, we're going to buy out your units. Here's a promissory note. We're going to pay this note out over time, but it allows you to kind of gain control of the company, gain control of the economics, and then pay out the partner over time. You certainly can, in the cases of death or disability, some insurable event, you certainly can plan to fund these with an insurance policy. I will say that the IRS, not the IRS, the Supreme Court has made this a lot more difficult with a case they decided a year or two ago about whether or not the company should be getting those policies, or whether it should be what's called cross insurance among the different shareholders. Shareholder A takes out a life insurance policy on shareholder B's life, and vice versa. When you get 3 or 4 or 5 partners, that can be rather complex. But nonetheless, you can try to structure these with an insurance policy and say, let's get a life insurance on partner A's life. And if A dies, we've got some proceeds to use to buy these people out. Um, uh, the fun doesn't stop there. You usually have to kind of think about how that policy is going to work and be structured. I can almost guarantee you that you're not going to get the amount of coverage right on the nose. So you're either going to be overinsured and underinsured based on what the price is. And so you need to kind of think through how you're going to solve the underinsured problem and what you're going to do in the overinsured case as well. So lots to think about there. And again, when you have multiple shareholders, more than two shareholders or partners, life insurance policies can get real complex real quick. I think the general consensus now is you have to almost to set up a new entity just to deal with the buy sell of different insurance policies. So, okay, last thing on our list is just to talk about things that we've talked about these buy sells, and we've kind of assumed that it's all really just simple and easy. And I think in practice, there are things that can make it a lot more tricky. And so some of those things that complicate buyouts are, there may be guaranteed obligations or loans outstanding where partner A, for example, the departing partner, is a guarantor of the loan. That partner may not feel great about being a guarantor of a loan in a company that they're no longer involved with or have any control over. So how are you going to solve that problem? Think about a situation where you took out a loan in 2021 or 2022 or something like that, where the interest rate's really low and the partner leaves now. I mean, company may find refinancing that loan as not feasible at this point with higher interest rate environments. So these guaranteed obligations or leases, for example, you may be a guarantor on a lease. It's unlikely that you're going to get those lenders or landlords to just release a party without getting somebody else or more security on the hook there. So sometimes you got to live through these situations and kind of contract around to get people to a result where it ends up working out to get the partner out, but it's not crystal clean there. There is a special buyout that we bring up in 50-50 partnerships or 49-51 partnerships where there's really only 2 partners of equal kind of control. That's called we call it Texas shotgun. I'll give you the gist of it right now, but partner A, partner B are 50-50. If there's a deadlock that occurs or a real dispute between these partners, the company could have some trouble here. So the Texas shotgun provision says, okay, well, if partner A says, hey, I'm done with this partnership, I can't work with you anymore. This is, irreconcilable differences between us that we need to resolve through a buyout. Then partner A might say, I think the partnership is worth X dollars, and therefore, your interest and my interest is worth 50% of X. Partner A establishes that value. Partner B looks at that value and says, would I rather buy or sell at 50% of X? And then they get to choose whether to buy or sell. So one partner picks the price, the other partner chooses to buy or sell. Pros and cons of that. I think the pros are, if you got a 50-50, this is a way to kind of unwind that without, litigation or trying to kick somebody out and getting sued or trying to dissolve the company or doing, nefarious things behind your partner's back. The cons are, I think that this sort of provision generally favors he or she with greater capital or greater access to capital. They may be able to basically buy out the other one at a cheaper price because the other one can't can't pull the trigger, can't buy the other one out. So something to think about there. I think among our 50-50 partnership clients, I would guess that this Texas shotgun gets used 15 to 25% of the time. It's certainly not a majority case scenario. I think people look at it as a pretty extreme. I look at it as a pretty extreme remedy and want to make sure it's being used appropriately. That is all I have to say about buy-sell agreements, and it looks like it's 12:30 on the nose, or 12:31 now. But I would be happy to entertain any questions from the gallery. Otherwise, I would thank all of you for coming and spending a little time with me today, learning about this. I will give everybody a couple more seconds for questions. Otherwise, I will close this up and appreciate everybody coming. Okay, I don't see any questions. I must have covered it perfectly. Have a good day, everyone. Thanks again. Bye bye.